and welcome to the Strides Pharma Science Limited Q4FY20 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note this conference is being recorded. I now hand the conference over to Mr. Abhishek Singhal. Thank you, and over to you, sir.
Good morning, and thank you for joining us today for Strides earnings call for the fourth quarter and full year ended financial year 2020. Today we have
The conference is now being recorded.
Dr. Anant, Chief Executive Officer and Managing Director, and Badri, Executive Director of Finance, to share the highlights of the business and financials for the quarter. I hope you've gone through our results release and the quarterly investor presentation, which have been uploaded on our website as well as the stock exchange. The transcript of this call will be available in a week's time on the company's website. Please note that today's discussion may be forward-looking in nature and must be viewed in relation to the risks pertaining to our business. After the end of this call, in case you have any further questions, please feel free to reach out to the investor relations team. I now hand over the call to Arun to make the opening comments. Over to you, sir.
Thank you, Abhishek. Thank you, everybody, for joining in, and appreciate joining in us early this time, considering that we are in very unusual circumstances that we all live in. We completed our board meetings late last night so that there was enough time to upload the presentations and also send it across to a wider community so that we could have a more informed conversation this morning. I hope all of you are being safe at home, and the lockdown, especially in Bombay, is panning out to be little more brighter than what we hear here in Bangalore. So, with this, let me just start off as Abhishek would have. Thank you, Abhishek, for the introductions, and like he said, I do have my other colleagues here who will address parts of this opening commentary. So I ended my watch as an executive managing director of the company on 31st of March. It's been a great year from several of the objectives that we set out when we went about course correcting the company both strategically and financially. But for a setback based on the ranitidine withdrawal request from the FDA, which came on the last working day. It's been a stellar year of performance, and my team and I am very proud of what we have achieved at Strides in the last 12 odd months. And we strongly believe there's great footing for Anant and his team to build from here, and strong foundations that's been laid across businesses as we transform this business even further. Two very important elements that have been achieved in the year is a very significant uptick in the gross margin levels. We improved our gross margins, adjusted almost by 11% and reported almost by 10%. And we have delivered 2 consecutive quarters where our gross margins have exceeded 60%. Now, appreciating the fact that we still have 25% of our business in the institutional and emerging market space where the gross margins are not as reflective. This is a phenomenal shift in our focus on product selection, execution, and absolute zero failure to supply. Some of the principal business rules that we set about in terms of capital allocation, return on capital employed, and also working capital management has played out well, and my colleague Badri will talk to you more about those matters. Later in the conversation, Anant will give outlooks as we live in very unusual circumstances. He will give you an outlook on COVID as we see it at Strides, the opportunities and the challenges. And therefore, we would not have specific guidances, but we will generally give outlooks which we will endeavor to update every quarter so that we make it more sharper and more focused based on the ground realities that we face. So if I look at the whole year, the biggest upside obviously continues to be the U.S. market. We guided in the beginning of the year for a performance range of between $220 to $240 million, adjusted for ranitidine we are at the high end of that range. Very, very important to us has been product selection, product introduction, and market share. We haven't lost market share on any product. We haven't had price drops on any products in the last 6 quarters continuously, and that's simply because we are not in the commodity products that most companies operate. We believe there's a lot more opportunities to continue this model. We've guided you several years ago that we believe that the US business with this strategy would get to about $400 million. We were hoping that we will get into a $100 million run rate about 18 to 24 months when we last spoke to you. This probably because of ranitidine may get shifted by a quarter or two, but it's not going to be significantly different from where we originally guided. I would like to strongly believe that the margin profile of the company will stay or improve even from here, and this is an endeavor that we constantly apply at Strides across our businesses. What we have done for the benefit of for our investors and for those who are on the call today, we have given a lot more granularity on our numbers so that there's a lot more. I mean, not that we are not willing to answer questions, it's just that we avoid a lot of confusion. So if you could see the US numbers that we've had, we grew this business in the last 8 quarters consistently from $25 million to $62 million. Adjusted for ranitidine in the last quarter, as you all know, the ranitidine was withdrawn after working hours on the 31st of March, so we couldn't do much to course correct that. So we have delivered an average of around $60 million of revenues per quarter. Considering that we've had a few product launches and we've now got introduced into the VA system, you will see that building this business back to where it was is quite easy, and Anand will give you more granularity around that. We grew the business in the last 5 years by 5x, from $50 million to $240 million. And the US business will continue to be a key focus for us. Added to our Singapore facility getting VA status and the Palm Beach facility going commercial in a couple of quarters from now, we believe that the tailwinds of Made in America and the VA opportunity will actually be more beneficial for Strides than ever before. We have a full page on ranitidine, so that we just kind of reiterating all what we've been communicating. As you all know, on 31st March, the FDA requested all companies, both in OTC and RX, to withdraw the products. The work that they've asked us to do will take several quarters. We do not believe ranitidine is going to be back in the market for at least 2 years if all the work that the FDA has asked us to do. We still believe in the molecule. We will continue investing time and money to see if we can bring the product back, but for us, this is clearly a setback. As you will know that when the FDA allowed us to sell the product on November 22nd, we were running an annualized run rate of $75 million on the product. So obviously that would have been a significant uptick from where we guided all of you, but more importantly, it would have added significant, it would have reduced the time for us to get to the $100 million per quarter run rate. But having said that, this is very typical of the market and the businesses that we operate in. This is an act not created by us, and we chug along. We're very focused on introducing new opportunities, and I just also want to take away several questions around ranitidine. I just want everybody to understand that we didn't price gouge. The numbers that you mentioned, that you see here, are without adjusting for other operational costs and other costs that have been attached in the ranitidine withdrawal cost of $17 million, because 100% of the gross margin has been deducted. Now it is quite normal for you to assume that our gross margins are significantly higher in the US than the reported numbers. And several of our products will meet this criteria, so we're very confident of filling this gap. fairly quick. Coming to the other regulated markets, has had a stellar performance. The business grew from $80 odd million to $118 million, delivering 47% growth. This business will continue to benefit from two elements. One is supplies now to the Aerotex Group in Australia has peaked to what we had expected to get to the $20 million EBITDA run rate when we announced the transaction. The fungibility of the Australian portfolio that we acquired is playing out. We got 20 products were filed and 16 approvals were received. Bulk of it were fungible products from the Australian portfolio. So that's played out extremely well. So not only are we benefiting from additional supplies to Australia, but more importantly, we are benefiting from a significant blitzscaling of our filing and approvals in the European market. Regarding filings, our US, as we guided a year ago, we have reached a plateau of what we think our model will need to deliver the $400 million run rate. And we don't see the need for us to keep investing on more products. We will continue to look at opportunities, but they will not be as profound as they used to be in the last 3 years in terms of portfolio. So that's generally about the other reg markets. The emerging markets and the institutional businesses, although you see a drop of 33%, what it clearly did for us, it delivered course correction. So our branded business in Africa is now completely operational from a hygiene perspective, from a productivity perspective. We may have some challenges this quarter because of the lockdowns in Africa. But having said that, this is a business that has bounced back to its full potential, and we're very delighted with the work that we have done in the last 24 months. The institutional business has been tepid, as we have been guiding everybody. But what it did for us is that by focusing on products which are profitable, we have delivered. It has also added tailwinds to our gross margin runway. With this, several financial outcomes have been achieved, and while significant new growth in the US has been achieved with limited expansion of the debt book or hardly any expansion of the debt book, this has been another year of tight financial controllership and great work from Badri and his team. So I'll now pass on the phone to him to speak about the key outcomes on the finance side before we pass it back to Anand. Thank you.
Thank you, Arun, and good morning to all of you. So in the next 2-3 minutes, I'll cover some of the key financial highlights. And financial year 2020 has witnessed a strong execution with superior balance sheet. Withdrawal of ranitidine was beyond our control. And we also laid strong foundation for sustainable EBITDA margins in future. And profitability, efficiency, and growth has been our focus through the last year, and we demonstrated consistency across all parameters of balance sheet. And for the year, we demonstrated solid operating leverage, which led to significant EBITDA margin expansion of almost 740 basis points in one single year, despite ranitidine. Interest and depreciation is at a very consistent trend, indicating a better financial leverage. EBITDA, ETR, that is effective tax rate, on the reported PBT is at 7%. We had guided the market that it will be between 10 to 12%. We have done much better than that. And we expect to maintain the same 10 to 12% in future. We also reported a strong operating cash flow of 2,500 million rupees. That is leading to a conversion from EBITDA to operating cash of almost 50%. And this was achieved despite a scale-up of US business from $150 million to $217 million. And we also completed all our capex programs except some small program which is in West Palm Beach. We spent about 1,300 million rupees in the last financial year. Post-Aero transaction, we guided a debt that we will be within a range of 10 billion to 12 billion rupees, and we are in the lower end of the range. We completed the year with 10.2 billion rupees. our debt levels have been very comfortable, and we believe that we are at a ratio of 1.9. We are at a ratio of 1.9, and we hope to maintain the debt to EBITDA ratio within a small range. We have a significant uptick in ROC percentage because of the asset sweating and also better operating leverage. And from a balance sheet standpoint, one of the significant points we have done is that we have reduced our contingent liabilities by almost 13 billion rupees. We have reduced the Watson guarantees. Guarantees what we gave for the corporate actions. We believe that we have the right pivots in place to continue on the growth trajectory, and our focus will be on generating free cash and improving the return ratios going forward. With this, I'll pass it on to Dr. Anand to make comments.
Thank you, Badri. Anand?
Thank you, Arun. Thank you, Badri, for the detailed commentary on the FY20 performance. And hello, friends. I feel privileged to have the opportunity of leading Strides starting this financial year. Clearly, Strides has achieved significant milestones with its contrarian strategies and perspectives on the business, and I strongly believe that my team will do its best to take this legacy forward and deliver on the expectations that the shareholders have from this company. Like Arun impressed earlier, notwithstanding the minor aberration in manufacturing due to the lockdown, our business in Q4FY20 did not have any extensive impact in the business from COVID-19. This is predominantly because of the way we manage our supply chain and our inventory levels in market. So the minor aberrations in manufacturing have only led to some depletion in our inventory and stock, but have no major impact on the business. Having said that, there is no denying the fact that COVID-19 is still an unknown element for the future of all businesses globally. We stay resilient as it is difficult to predict the challenges of the industry should there be further worsening of the situation. As a company, we've maintained our agility and responsiveness to the emerging trends and have periodically brought forward necessary changes in the way we run our operations. Our immediate response was to pursue a people-first approach and focus on the well-being of our employees. We've been adhering to all government and health authority guidelines that have been prescribed for each of the jurisdictions we operate in to safeguard our workforce globally. In various preventive measures, we've been carrying out deep cleaning, sanitization, disinfection programs across all our locations as we adhere to social distancing norms, including allowing a significant fraction of our employees to work from home. All of these have been a momentous shift for us in the way we operate as an industry. Still, we are pleased that a combination of these efforts led us to focus on continuity of the business such that we could discharge our duties towards the patient population. I am extremely thankful and very appreciative of all my colleagues across all our facilities globally to ensure continuous operations during these challenged times and to ensure continued delivery of products for our patients. Our team has chartered a business continuity plan for Strides, which intensely covers aspects such as how we conduct our manufacturing, how we secure our supply chain, approach our customers, and manage our workforce in line with the evolving landscape. We stay focused on conserving capital and identified austerity measures along with many areas for improvement. In summary, we are pursuing our commitment to our 3 Ps, that is patients, people, and purpose as we continue to monitor this situation. Even though uncertainty exists in the magnitude and impact of the COVID outbreak, we strongly believe that our businesses are well positioned to deal with this, and we look forward to a promising performance in FY21. Let me now take you through outlook for FY21 and some of our key businesses. First, the US business. We stay positive and are very confident of our performance in the US markets going forward. We clearly believe that we can grow our business by 25 to 30% on the adjusted FY20 revenue of 192 million, even without Ranitidine. Our US markets will benefit from improved market share for its base portfolio, introduction of new products, including the ones that are already approved and not commercialized, and through enhanced market penetration in opportunities, including the VA program, in which 2 of our global sites qualified to be in the designated country. To give you some more clarity on this, we launched 6 products in Q3 in FY20, which delivered revenues of about 20 million for FY20. These products have an annualized revenue of about $45 million, which we would clearly realize in FY21. And our focus is to grow our market share in all of these commercialized products. As I said earlier, we also have a basket of about 35 products that are approved but not commercialized. We clearly look forward to introduce at least about 5 new products from these already approved product basket as we build out our strategic play in the evolved business landscape. And all of these products clearly on introduction meet our new supply chain and our financial thresholds to be able to ensure that we maintain the margins that we've been able to build in the US market. We also expect a significant ramp up in the supplies under the VA program with at least 5 plus additional products. We expect about 10 to 12 new product approvals in FY21, and we also expect to file about 12 to 15 new ANDAs during this year. Our other regulated markets also have shown a significant improvement in the business, and this strategy will continue to play out well. We expect the growth to continue in the ongoing year as we target higher operating leverage and a large pipeline of approved products with market fungibility. We do expect about 20 plus new filings in this year for the other regulated markets, with about 15 plus new product introductions across several markets. We have also achieved significant improvements in gross margins in 2 quarters consistently across in the organization. And with that consistent performance, we are reasonably confident on maintaining that level of gross margin for the company. In summary, I would like to sum up by reassuring all of you of our commitment and confidence in the business as we progress into FY21. With this, I hand it over back to Abhishek or the moderator. Thank you.
Ikram, we can take the questions, please.
Yes, thank you very much. So, ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. In the interest of time and fairness to all participants, please restrict questions to 2 per participant. If you still have more questions, kindly join the queue afresh. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1. We have first question from the line of Alankar Garude from Macquarie. Please go ahead.
Hi, good morning, everyone. Sir, you achieved about $111 million of US sales in the first half. Now, this includes about $9 million sales from ranitidine, which makes it about 102x of ranitidine. And in the second half, without ranitidine, we did just about $90 million. So what explains this lower ex-ranitidine US sales in the second half versus the first half?
Yeah, so Alankar, basically, you know that we allocate capacity based on our business model, right? So when we knew the uptick of, when we knew there was an uptick of the ranitidine coming our way with the sole supply status, we were allocating capacities. And don't forget that we had this issue at Pondicherry. So we had a certain limited capacity that we had to allocate. And therefore, we were obviously producing ranitidine simply because it made up for lower unit volumes, but significantly higher margins. So in absolute terms, while the revenue numbers would have been lower, the gross margins between H1 and H2 are almost similar.
Understood. So in this context, Arun, how should we look at this 25 to 30% number? Is it more of an aspirational number, or should we take it as a firm guidance that $240 to $250 million sales number for FY21?
I think, Alankar, all guidances are aspirational. The only thing is that when we've told you some things, we have done it. So I leave it to you to decide if it's aspirational or guidance.
Understood. And one final question from my side, Arun, for you. So now that the Sequent deal is completed, should we expect your side of the pledging in strides to go down to zero?
Yes, you can.
Sure. Great. Thanks and all the best.
Thank you.
Thank you, sir. We have next question from the line of Chirag Dagli from HDFC Asset Management. Please go ahead.
Yeah, so thank you for the opportunity. In your opening remarks, you mentioned you have 35 products approved that have not yet been launched, and you will launch at least 5 of those. Did I get that right, sir?
That's correct, Chirag.
So what is it that has changed, sir, in this environment? Is this external environment where pricing has changed, or is it that Strides is now internally geared up to supply chain challenges for those products? And how many more can we expect through the rest of, let's say over the next 2 to 3 years? How many out of these 35, can we expect launches?
Yeah, sure. So, as you know, it's clearly a strategy that when we get a product approved, it's not necessary that we may launch the product immediately. There are some products that we launch, but many of them, there are several factors that we consider. One is building up our supply chain strategy, number one. Number two, to ensure that we are able to maintain our gross margins in the products that we launch. And when these criteria are met, then we certainly take a look at launching the products. So all of these products that we are saying we are going to launch now have been a build-up of all the work that we've done over the last 2-3 quarters to be able to be ready for launch, and it comes up now for launch, and therefore we are saying that we will be able to launch these products from the portfolio.
So Chirag, just one other point to consider is that we've done a few transactions, as you know, the Venson acquisition, the Vivimed acquisition, and along with them comes ANDAs which they don't commercialize, right? And that could be because of poor API sourcing, poor capacity building, or even a poor process. So when you do all those changes, it typically is the typical strategy of a large change is a 1-year process. So when we get to that position of doing all those changes, we are sure of meeting all the financial outcomes that we want, because we are not chasing top line in the US.
Understood. And sir, in your opening remarks, you also mentioned that you have achieved peak EBITDA that you guided for Australia. This is like in the fourth quarter you achieved that annualized run rate, is it?
What I said in my statement was that we now have the run rate this year, in this financial year, to get to a peak EBITDA that we have guided on the Australia transaction.
Understood, sir. Okay, sir. Thank you so much.
Thank you, sir. Participants, to ask a question, please press star followed by 1 on your touchtone phone now. We have next question from the line of Nitin Agarwal from IDFC Securities. Please go ahead.
Hi, thanks for taking my question. Arun, and on the business as we look forward, post the adjustment that we post the ranitidine adjusted quarter, the normalization process, is it going to be essentially a H2 loaded sort of trajectory, or we see normalized numbers in the business sort of coming through right from the early part of the year itself?
So this will keep building up over the quarters, Nitin. It is not, this will keep building up, and of course, it will have a significant play out as we move from one quarter to the second, to the third, and to the fourth. The impact will start getting even more firmer.
Okay. And secondly, you mentioned something in the presentation around certain ARV or HIV drugs and all getting repurposed for COVID-19, as well as we've already announced our launch of Favipiravir. So any sense, any color on how should we look at this opportunity landscape for us going forward?
Yeah, please.
So basically, repurposed drugs are all up in the air. Several countries are creating their own protocols. And as you can see, many countries have taken off HCQS from the protocol, but yesterday Brazil has put HCQS as the primary treatment regimen. So everybody is creating protocols based on science or or lack of it. And at this time, we live in a world of ambiguity. FAVI, as you know, is not approved anywhere, including for the innovator for the use for emergency use. Yet in Japan, it is being a part of a major protocol because of the studies that FAVI went through in China. So it's a wait and watch situation at this time. We are not factoring any significant upsides as yet on any of these programs. But the fact is that we have antivirals in our portfolio which can be repurposed. We have a whole basket of products, right from all the Weaves to the Asalta to FAVI and all of them. So, we are just at this time we are ready with everything, but it depends upon which country, what protocols, what's the next wave looking like. So we can't give you a definitive color on the opportunity around the repurposed drugs.
Thank you. If I can squeeze in last one. On the ARV business, we had talked about our TLD, dolutegravir formulation approvals coming through. What is the status on that?
So we're still awaiting the regulatory approval on that. So once the approval comes in, of course, we'll certainly have an opportunity to participate in the TLD.
And how is that going to work? Once the approval comes, is it going to be a lag before the orders begin to come through? Or, how does the cycle play out on that account?
Sorry, could you come again?
I'm saying once we get the approvals, is there a significant lag time between from when the approval comes and when it starts translating into business, linked to the tenders, I presume?
It is. So I think as soon as the approval comes, we'll of course let the agencies know about the approval status, and then we should start seeing the opportunities flowing.
So to answer specifically your point, there are two sets of procurement. One is the annual contracts. Those are typically already issued out. We won't be part of that anymore. But then there are country procurements and the procurements of the USA, all of that are spot. The spot opportunities we will get. And then there are several countries that buy TLD outside of the donor business. So there's still a very large product, about 50% of the total ARV funds spend is now on this particular product. There are supply chain issues, as you know, on this product. So we still believe that we're not too late, and as soon as we get approvals, we should see some upside.
Okay, thank you.
Thank you, sir. Reminder to participants to ask a question, please press star 1. We have next question from the line of Ravi Sundaram from Sundaram Family Investments. Please go ahead.
Thank you for the opportunity. Sir, a couple of questions. So the first question is just a quick follow-up on what the previous participant asked. So on TLD, right, do we have the capacity to support the orders if they come through? And if what approval are we waiting? Are we waiting for the PEPFAR approval, or is it the Global Fund approval for TLD? That was my first question.
Yeah, so the PEPFAR approval is not yet due. What we are getting now is the WHO approval, which will give us access to about 50% of the opportunity, and we have enough capacity.
Okay, and what did you say about capacity? Sorry, sir.
I said we have dedicated capacities for antivirals.
Okay, thank you. My second question is on the supplies for APIs. If you see, the current quarter had a significant lockdown, especially in India in the first half of this quarter, April and almost some part of May. I know pharma companies are not impacted as some of it was categorized as essential. My question is, was there any significant impact in the current quarter due to API supply?
No, we did not have any significant impact on account of API. As I said, we've been managing our inventory levels and supply chain reasonably well on that, and currently in this quarter we did not have any major impact.
Okay. One last question, if I may. How has been the pricing in US this quarter? Because previous quarter was one of the best quarters that we have seen for the entire pharma industry as such. But how has it been this quarter, sir?
This quarter has remained pretty stable. We have not seen any impact on erosion. This has been a pretty stable quarter on pricing.
Okay. Thank you very much. I will come back in the queue.
Thank you, sir. To ask a question, participants may press star 1. We have next question from the line of Hari Belawat from TechFin Consultants. Please go ahead.
Good morning, sir. Congratulations for the good revenue and EBITDA compared to FY19. Now, sir, this ranitidine was withdrawn on the last day of FY20. Then how come this reported and adjusted figures are so much different?
That is because we are estimated for returns. See, we don't know how much returns will come. So we have made an estimate for returns. And if it is lesser than that, then we will write it back. But at this time, we have no idea on how much returns will come back. Any recall is a long drawn process.
Okay, so the official figure is the reported figure presently as on date.
Yes.
Correct.
Okay. Thank you, sir. This is the quick query. Thank you.
Thank you, sir. To ask questions, participants may press star 1. We have next question from the line of Anuran Mitra from Thomson Reuters. Please go ahead.
Hello, good morning. So my question is regarding Favipiravir. So the last press release that Strides has put out, they said that you will apply to the Indian government authorities to commence necessary studies. So I just wanted to know whether there's been any update on that. Have you got the approval and nod to conduct trials?
We have the approval to conduct human study, and we will be starting the study soon.
And this is in India, right?
In India, correct.
From the DGCI?
Yes.
All right. Thank you.
Thank you. We have next question from the line of Nitin Agarwal from IDFC Securities. Please go ahead.
Hi, thanks. So two things. One is on in the presentation we've sort of highlighted that adjusted for ranitidine, our gross margins for the quarter were about 60%. So is that fair to assume that for the whole of next year, going forward rather, that's like a base number to run with for the business gross margin?
That is a fair estimate.
Secondly, Arun, on the VA business, we talked about there is an incremental $20-25 million opportunity on the existing launches we've done, and there are a few more launches which are lined up. Now, these are all launches that will be largely coming in from the Singapore as well as the Palm Beach facility.
That's right.
That's correct.
Okay. And we also did buy a bunch of ANDAs from which you announced, I think, about 6-7 months back. How should we? Can you help us understand how should we look at that part of it playing out?
So it typically takes a year because these ANDAs, except for one product, didn't have any sales, and we have already tech transferred the product that is where there is a significant sale, and this particular product has got a VA orientation too, so we are making it at Singapore. That will be filed very soon, and all the other products, if they were not commercialized, it's because either the process was inefficient or the API source was not cheap. Competitive enough for us to get to our targeted margin. So typically, the work that we do, and this is where we say that when we have typically in our ANDAs we are able to launch very quickly, but on the acquired ANDAs we take approximately a year to get our supply chain right, our process corrected, and in some cases even do another B study if required, and that takes up to a year to launch. So the whole portfolio gets relaunched over a period of time. That's why we have a fairly long tail of uncommercialized products. But every quarter now we are bringing 1 or 2 products back in.
Okay. And if I can squeeze in one last one on this,
when we look through the next year, across various business sort of segments, I mean, qualitatively, where could there be a potential of sort of meaningful surprises that can really come in the business? Or, I mean, are there opportunities like these in the business qualitatively? And what could be the nature of these kind of opportunities?
So you're talking about positive surprises or negative surprises?
I mean, hoping for positive for now.
So I think the reg market, Nitin, is all set. I think it'd be fair to assume that 80% of the business will have very solid growth, profitability, and cash flow. The business which is still ambiguous would be the donor business, because we think there would be a shift of attention, not less capital, to COVID. And I think the lockdown will significantly increase impacted people with TB and malaria, unfortunately, and HIV. But I just think that the donors will be more preoccupied on COVID, given the, I mean, for all good reasons. So if donor funding doesn't come through the way it normally should, then there would be probably reduced allocation to all countries. But these are early days.
Okay, thank you.
Thank you, sir. We have next question from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, good morning, sir. Can you give us some sense on the capex for the current financial year and any debt reduction plans if you have?
So capex for the coming year, we plan to do about $15-20 million, which is more of a maintenance capex for the coming financial year.
Okay. And how do we see the net debt figure, sir?
So we expect to maintain in the similar range, in a small range. So currently we are at 2. So we expect to maintain with a variation of about 10%.
Net debt to EBITDA, you are referring, right? Hello?
Yeah.
Yes.
Secondly, sir, any more investments we need to do in the two associates in FY21?
There's a committed investment into the biotech arm that is already announced and shareholder approvals received. So that will continue this year.
Okay. Any sense you can give us, sir? What is the approximate number we need to put into these two?
$40 million.
Yes, 40 million. We said that last September that it will be over a period of 18 months, and we are done about 12. So the balance will be done in the current year.
Okay. And this net debt figure you are referring is assuming all the, including both the capex as well as the investment in the associates, right, sir?
Yeah, it's a debt. It's a debt netted in it's a gross debt minus the cash.
Okay. And yeah, thank you so much, sir.
Thank you, sir. We have next question from the line of Tushar Manudhane from Motilal Oswal Financial Services. Please go ahead.
So just a clarity on US side. So including 4 to 5 from already approved, how many total launches are we expecting for FY21?
So we are looking, as I said, we are looking for at least 4 to 5 new products to be launched from the already approved portfolio, and we are looking also to get at least 5+ products into our BA program.
Okay, so from the new approvals, say for FY21, probably the launches would be a year later. Is that the right way to?
Among the products that we have, we said we will launch during this year. A couple of them could be from the new launches that we would get during the year.
Okay. This PA program, now that it's been just started, so any color on how much of the business can be expected specifically from this VA program?
So on the VA program, again, as we said, we gave color to how our new product launches that we did in FY20 is likely to ramp up in this year. We see and believe that the VA product can also have a similar kind of a ramp up.
In terms of value?
So it could also be in the $20 to $30 million range.
And the OPEX associated with these facilities is already in the, let's say, the Q4 numbers, or there is going to be incremental operational expenditure associated with these?
No, we've already done all the work that is needed from site transfer. There's no additional expenditure that is needed for these products.
Okay, sir. That helps. Thanks.
Thank you, sir. We have next question from the line of Chirag Dagli from HDFC AMC. Please go ahead.
Yes, sir. Thank you for the opportunity. So when you think of the business today, you talked about maintenance capex of just $15, $20 million. Are there any white spaces that you want to fill in now? How are you thinking about, any large? So you mentioned about biotech, which is part of an associate, but outside of that, are there any large white spaces that you think you won't need to fill? Or is this how you think, business will be run?
No, I don't see us looking at any large white spaces right now. I think given the current scenario under the COVID circumstance, we're looking clearly to also focus on cash conservation. And therefore, our focus is really on the maintenance capex for this year.
Understood. And is there a tax rate guidance you want to give?
Between 10 to 12%.
Okay, same. All right. And so this quarter, most companies have done very well in Europe. Are there any thoughts that you want to share with us on what's happening with the market in terms of pricing, volumes? How are you seeing this market develop in FY21?
We have been doing very well in Europe for the last 4 quarters, but it's only now when the herd also does well that you started recognizing it. The fact is that if you look at our commentary, we mentioned that we have built out on the US and our focus is in Europe. We had a great run in Europe. We've already built that business from almost $0 to $100 million in the last 3 to 4 years. We see the opportunity to be significant, more challenging because of some of the smaller fringe players getting out of the business. Serialization, Brexit, all are playing positively. And we are benefiting from that. And you'll see significant growth coming from Europe for Strides 2. And as you can see, we've got 20 filings, 16 approvals. So it's significantly more. It's just that everybody gives too much attention to the US, but Europe is equally becoming an important part of our strategy.
Have you called out Europe separately in your for FY20, sir, in terms of the size?
Our other red markets is all about. Yeah, we have done that in our previous presentations.
I will pick it up, sir. And sir, any thoughts on pricing in the US? Are you seeing a turnaround or flattening out, bottoming out?
It's steady and positive, stable.
Understood. Thank you, sir.
Thank you, sir. We have the last question from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Hello.
Hi, go ahead.
Thank you very much, sir, for the opportunity. Sir, just my line got disconnected, just in case you have already answered. So what's the near-term impact of COVID you're seeing in your business overall in the supply chain or maybe on the business front?
Yeah, so we did answer that. From the COVID perspective, at this point of time, we've seen only a minor aberration in manufacturing. But as I said earlier in my commentary, it's also because of our supply chain planning and managing the inventory levels. So there has been only some depletion in the inventory levels, but we have not seen any major impact coming in because of that. Having said that, it's an unknown element, and we'll have to keep continuing to watch and see how it plays out.
Understood. So that you expect to continue into first quarter as well, like in terms of minor, no major shock for our business side.
Correct.
Okay, fair enough. Yeah, that's it from me. Thank you.
Thank you, sir. Ladies and gentlemen, that was the last question. I'd now like to hand the conference over to the management for closing comments. So over to you.
So thank you, everyone. Thank you for the call. And as we said again, we continue to reassure you of our commitment and confidence in the business and look forward to having the conversation back at the end of Q1 as we progress positively into the year. Thank you.
Thank you all.
Very much, sir.
Thank you and be safe.
Thank you very much, sir. Ladies and gentlemen, on behalf of Strides Pharma Science Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your lines.